Hello, good evening, everyone. Welcome to this session organized by SIAS Corporate Connect, featuring Fuyu Corporation for this evening. Um, Welcome also to our audience from Mumu Live to this session, which is organized by SIAS, Securities Investors Association of Singapore, and the SGX Group. There's a slight change in the sequence of the program today. We will start with a presentation by the company, a corporate presentation by Fuyu, followed by Q&A from the public. So please enter your questions into the chat box, and we will try to answer as many as possible. After that, we will end the session with a presentation by the SGX, Ms Emelia Tan. Ms Emelia, Director of Research and FinLit for SGX Group. All right. A little bit of a preamble before I introduce the team from Fuyu. Fuyu is a leading provider of precision plastic components and supply chain solutions. With over 40 years of experience, the company has established a strong global presence, operating manufacturing facilities in Singapore, Malaysia, and China. Fuyu offers a comprehensive range of services from product design and engineering to manufacturing and supply chain management, catering to a diverse clientele of blue-chip companies across various industries, including printing and imaging, networking and communications, consumer electronics, medical devices, automotive, and power tools. All right, with that preamble out of the way, I'd like to welcome the management team from Fuyu, led by Mr. David Seow, the Group CEO for Fuyu Corporation, along with the rest of the team, Ms. Daisy Ong, Chief Financial Officer, and Mr. Adriel Loh, Deputy COO. And led by Mr. David Seow, this is the management team that will do the presentation. So I'll hand it over to the Fuyu team now.
Hi everyone. I'm Adriel. Thanks for the introduction, Sivan. So good evening, everybody. Thank you for dialing in. Special thanks to SIAS for arranging this call, and also for our shareholders and potential shareholders for dialing in today. My name is Adriel. I am the Deputy COO, and I will start the presentation. I'll give a quick run through of what Fuyu is, what we do, some of the products that we make. I'll then hand over the time to Daisy, where she will run through some of the latest financial information. And David will start talking a little bit about our transformation and our updated strategy. And as Ivan mentioned, we will have a Q&A after that. So let me just jump straight into it. Could we go to the next slide? So what is Fuyu? Fuyu was founded in 1978. We were listed and have been listed on the SGX since 1995. As Sivan had just mentioned, next year will be our 30th year in being a listed company of SGX. So it's something that we can celebrate, I suppose. In 2021, there was a change of control where the original founders of the company sold their stake to a fund, Pilgrim Partners Asia, where they took a 29.8% stake. With that, the new management team came in and we embarked on a transformation plan where we are focusing on our core engineering skills in tooling and also targeting the biomedical sector, which has, as we all know, undergone a big transformation post the COVID years. Thankfully, we do have a strong balance sheet, which will allow the group to embark on these initiatives, such as building our smart factory and focusing on higher precision plastic components. Next slide, please. We've shared these up. Okay, thank you. Maybe we'll jump to the next slide. So Fuyu, just very quickly on what we do, our core business is in mold making and molding, plastic injection molding. And over here, there are just two main important things. One is the mold. A lot of technology a lot of engineers are required to make a mold. And why is that important? To make good parts, we need a good mold, especially in this age where automation is required, and we need a good mold. And hence, over the past year or two, we have invested a lot in our tool making capabilities, so that when we go to our automated production, the parts that come out will be repeatable and of high quality. Next slide, please. We serve a diverse range of customers. We segment them mainly into 5 main market segments: the medical segment, optical, consumer, industrial, and automotive. I will share a little bit of each segment in the next few slides. Next slide, please. In the medical device space, we manufacture parts and components for medical devices, ranging from case parts, for example, the case parts of heart rate monitors, and to all the way to higher precision components such as test kits, endoscopes. Next slide. On the consumer front, we've actually been in the consumer segment for since we started in 1978, and with that we have a large variety of products in this space, from water filters, air purifiers, to smart home appliances, power tools, and even the new smart wearable electronics is a segment that we are also growing quite fast in. Next slide. In the optical space, this is interesting because what we can do is we can make plastic lenses, so transferring the normal glass lenses to plastic lenses, and the use cases would be in the newer growth segments, for example, sensors and autonomous driving technologies. Next slide. I shared a little bit about the automotive segment, and this is where we can make components for practically every part in the car, from the case part frames to in the body of the car, all the way to the parts within the engine itself. Next slide. And our last segment, the industrial segment, again, with the transformation towards Industry 4.0, we see a lot of autonomous robots and robot arms. So we also do provide parts and components for these products. Next slide. So where is Fuyu located? Fuyu has grown from a Singapore company where we are headquartered to 6 locations across Asia. We have 2 sites in Malaysia, in Penang and Johor, and 3 factories in China, Suzhou, Dongguan, and Zhuhai. The next segment will be the financial performance, where Daisy will run through. Thank you.
Okay, thank you, Adriel. Good evening, everyone. I'll be sharing with you our financial performance for the 9 months ended 30th September 2024. So first of all, the top line revenue. For the 9 months 2024, we have achieved a revenue of 162 million as compared to 104 million in the prior period. The increase of 55% is mainly due to higher revenue from our manufacturing and supply chain management segment. Manufacturing segment recorded 86 million for the first 9 months 2024 as compared to the prior period of 79 million. The increase is mainly due to the contribution from our Singapore, higher contribution from our Singapore and Malaysia operation, which is offset by lower sales from China operations. As for the supply chain services segment, it posted 76 million for this period, mainly derived from sales of products such as marine gas oil, biofuels, and coal. Next, in terms of gross profit, it increased 28% to 12 million as compared to 10 million in the prior period. That's mainly due to the higher top line. Next, in the GPM, for this period, it stood at 8% as compared to 9% in the prior period, and that's mainly due to the change in revenue mix. EBITDA before forex change has increased to 6 million for this 9 months as compared to 100,000 in the prior period. That's mainly due to the growth in the manufacturing segment. And in terms of operating profit, we have achieved 800,000 for this 9 months, reversing from the operating loss of 7 million a year ago. So overall, in terms of net profit wise, we recorded a smaller loss of 2 million as compared to 6 million in the prior period. So these slides show a breakdown of manufacturing revenue by market segment. As you can see from the right side of the slide, that the main contributor of our market segment is mainly consumer and medical, which represent 46% and 28% of the total manufacturing revenue respectively. Lastly, the financial performance in terms of our balance sheet, as Adriel has mentioned earlier, our balance sheet is still relatively strong with net asset value of 138 million, which translate into a net asset value of 18 cents per share, taking into consideration the outstanding shares of 762 million. And we remain a net cash position of 56 million, which translate into 7 cents per share. And with that, that's the end of the update of my financial performance, and I'll pass on to David on the next segment. He will take us through our transformation plan. Okay.
Okay,
to you, David.
thank you, Daisy.
Okay.
Thanks, Daisy. And good evening to everyone, and thank you for spending your evening with us. I will just briefly go through what our strategy is over the next few years. So we call it our strategic transformation, which is underpinned by 5 key strategies. So we came up with this strategy last year after doing a landscape analysis. And, you know, in the world of a lot of uncertainty, trade wars, and basically a reconfiguration of supply chains because of what's going on, we decided that it's important for us to sort of relook at the business and future-proof the business and target spots of growth and to move away from spots of decline, basically. So the 5 key strategies I'll go through right now. The first strategy, Daisy, the next page, is basically going back to basics, which is tooling. So as Adriel shared earlier with regards to our capabilities, we both manufacture molds as well as do the injection molding of the parts. So for us, there is a saying which is the heart of a good part is actually tooling to make a good tool. So for us, we are going back to basics, which is to create good, high quality, high precision molds. And with that, what we've done is we've launched the new smart factory, which we have in Singapore. And that allows us to add high precision engineering specialists. We have invested in a lot of new machines that allows us to do scientific molding, reverse engineering, and ultimately to be able to create complex and complicated molds that we sell to both our customers, who we do the molding for them, and it also allows us to sell to competitors of ours who are injection molders, and they don't make the molds themselves, they buy it from us. So we've started this for about 2 years now, and basically we've got good traction where we've gotten new customers in the US, Europe, as well as Asia. Next. So here's a very quick snapshot of our smart factory. So as you can see over here, we believe that we've got one of the most advanced precision manufacturing facilities in Singapore. With the launch of our new building, which is the smart factory, we were able to triple the space, where it was 2,700 square meters previously, and it's now almost 10,000 square meters. With it, inside this factory, we have a lot of high-end machinery that supports our tooling business. So that includes a 3D metal printer, high levels of automation, as well as a brand new manufacturing execution system, which allows our factory to be smart and connected with all our machines so that we can have up-to-date data management and preventive maintenance as well. So Next, Daisy. Our second strategy is basically going and focusing in the biomedical sector. So as Adriel covered earlier, we do have client segments which are very diverse, but then why we have targeted the biomedical sector is because of a couple of key reasons. We believe that this is a high growth market. That's one. We believe that this market is also it's a high barriers to entry market as well. So which means we have less competitors in this space, but it also means that we need to have the capabilities to fight in this space. So this is a very exciting market for us. And we also do have some traction with new customers as well. And some of the parts that we can share that we are looking at manufacturing and or already have manufactured are things like endoscopes, valves, microfluidic devices, as well as syringes. Next. Our third strategy is basically focusing on sustainability. So what used to be a buzzword, sustainability, is actually one of the core pillars of our business right now. So a lot of our customers are MNC customers, and they have their own sustainability policies. And for us, not just because we are a listed company, but at the same time, we do believe that sustainability is very important to the business. We have embarked on our sustainability initiative from a few years ago. Today, we are proud to share that we have solar panels installed in all our Singapore plants, or rather all our Singapore buildings. By the end of the year, we would have solar panels installed in all our Malaysian plants as well. We do have other initiatives, which you can see on the screen. But long story short, basically, this is a very important initiative of ours, and this initiative will continue to be sort of an investment for the company. And we do see this as very important, not just from a sustainability, ESG perspective, but it is also important in order to clinch new business with the MNC customers out there. Next, Daisy. The fourth strategy we have is basically going up the value chain. So Fuyu used to be a built-to-print company, which means customers, they would have their designs all ready and they send the designs to us. We quote with competitive prices and we hope to win. So that was the old business model. But now we have a new NPI team, a new product introduction team. And this team basically consists of engineers that are able to talk to our talk to our customers at an early stage. So before the design is firm, before the design is sent out for us and competitors to quote, our engineers actually engage with the potential customer to help them with the design of the product, even at concept stage. So by being able to engage with them at an early stage, it does give us a lot of advantage in terms of winning the eventual business, because we are part of that decision-making process. We understand the product at an early stage. And this is something that is new to the company, and it's very, very important for us. Next. And yes, the fifth strategy is basically, while we say it's raising profile with our stakeholders, it's basically rebranding ourselves. Because with our new capabilities, we've basically retooled our capabilities. We had to refresh our brand with our customers, but also along with all the stakeholders involved. So one of the perks of doing this in the past year was we were identified and selected to join the Scale Up program by Enterprise Singapore. And we've just finished it, but basically this program has allowed us to get the support of the Singapore government, and they've helped us to sharpen our focus on key growth markets. And they've given us a lot of help in order to expand our business on a global perspective. Yeah, and I guess the last thing that I can share also is with the new capabilities and the new refreshed brand that we have, the number of new customers that we've been able to clinch since January 2023 has been 25 new customers, which is a very encouraging figure, given the fact that the years before that, the company struggled to get new customers because of our inability to win and to convince them with our capabilities back then. Next. So to end off this segment, we would conclude and give an outlook. And basically, We do think that the industry outlook is still very difficult. A lot of headwinds which could hamper the pace of recovery of our business from a macro perspective. So we are seeing longer shipping lead times, higher costs of raw materials, and obviously the geopolitical tensions arising from the US, China, and actually other countries that are also in the mix. So with this, we do have a plan for our Chinese plants, which has suffered during COVID. We have a China for China strategy where a lot of our customers in China are domestic Chinese companies, whereas our plants in Singapore and Malaysia are to support international business, where they are mainly from America, North America, as well as Europe. So in terms of the group outlook, we have recorded higher order volumes and inquiries for new projects. So that's very encouraging. And our business momentum is expected to continue to grow in the second half of 2024. And finally, we do believe that our strategic initiatives to enhance our manufacturing capabilities and to expand our customer base is bearing early fruits. And we will continue to execute the key corporate strategies, which I mentioned, in the coming months and years as well. Yeah, so with that, we have concluded our presentation, and I think we can open the floor to questions.
Right, thanks very much, Daisy, Adriel, and David for that presentation. I'll now open the Q&A segment. Please feel free to submit questions into the chat box. For our Mumu audience, do click on the link to join us in Zoom and post your questions. And we'll try to answer as many questions as possible from the floor. So far, there's only one, okay, maybe this one I can marry with one of the other questions that we have, which is what caused Fuyu's share price to fall from over 30 cents to its current price. Maybe I can switch this around to ask you, can you say with confidence that Fuyu has now emerged from its recent difficulties, and whether it has turned the corner?
Okay, so I will take this question.
Okay.
I wouldn't be able to answer you directly, but what I will say is the share price as a result of the financials, especially I think a lot of you would have seen our FY 2023 financials, which were not good. The financial performance was poor as a result of the business of Fuyu back then in late 2022 and 2023. And the issue back then was post-COVID. A lot of the medical customers that we had, which were high GPM, high gross profit margin businesses, they have since had their own issues. So it's widely known that a lot of medical companies back then, they overstocked in 2022. So there was an influx of orders, and they were willing to pay a lot for production, because the fear back then was, supply chain disruption, not enough inventory to sell. So 2022 was a good year. It was a bumper year. But late 2022 to 2023, we did see that there was a normalization, or actually a knee-jerk reaction, actually. So a lot of these companies, the inventories that they stocked up, they were not able to sell. And from what we also see today in the market, a lot of them still hold inventory that they made in 2022, or that we made in 2022. So that explained the decline in the business in terms of revenue, as well as the GPM, which I mentioned. One issue back then is with the falling revenue from existing business, was it covered by any new customers to the group? And the answer back then, the answer is no, because based on our capabilities back then, we were not able to attract new customers. But with our strategies that we've implemented since last year, and the team has spent a lot of time, a lot of effort to really retool our capabilities, we are seeing that 25 new customers that we've had so far in the last 1.5 years. So we do see that in terms of new customer acquisition, there is a turnaround because there is traction there. And we believe that that will equate to higher revenue, and also it would help the bottom line. So I think, sorry, I know you are expecting a more clear-cut answer from me, but this is what I'll share with you.
Yeah, that's fine. Cautious optimism, I guess. Right? Okay. Next question. There are actually two, Andy Seow and Chias has more or less asked the same question. Given the potential tariff that the Trump government will impose, how will Fuyu be affected by its China operations? And the other question was, by how much will Fuyu be impacted by any anticipated tariffs imposed by the US? So more or less the same question.
So there will be an impact, but the impact will be minimal. The reason for that is since the trade war started, a lot of our manufacturing for international customers in China, that business has shrunk. And it has shrunk to a level where any further tariffs will not really have that much of an impact. And as what we mentioned in our strategy just now also, for China, our three Chinese plants, we do have a China for China strategy, which means we're actually targeting manufacturing for domestic Chinese companies. So with the tariffs, there wouldn't be as much of an impact on our Chinese plants if and when these tariffs kick in 2025.
Okay, excellent. Thank you. We'll move on. Josh Liao has asked about it is great to see sustainability efforts implemented by Fuyu's plans. As a manufacturing and supply chain provider, is Fuyu able to share a general approach towards measuring its scope 1, 2, and potentially 3 emissions? Wow.
That's a good question.
Good question.
We actually have a sustainability specialist on our panel. So it's Adriel. Maybe Adriel, do you want to take this question?
Yeah, sure, definitely. I think this question has to be answered in context of where is Fuyu, what is Fuyu's role in the global supply chain? We mostly manufacture plastics, right? And we supply to a lot of MNCs, right? If you look at our scope 1 and scope 2, which essentially is our emissions, some of the efforts that we are doing is to reduce our dependency on traditional, well, I'll say coal-fired, I wouldn't say coal-fired, but traditional electricity. For example, David shared that we are installing solar panels in Singapore and in Malaysia. And of course, we are transitioning some of our older machines to more efficient machines. Now, if you look at a manufacturer like ours, actually about, I would say 50 to 60% of our total carbon emissions are scope 3 emissions. Now, scope 3 emissions for a company like ours essentially are the plastic resins. And tackling the plastic resins is interesting but difficult area. Why? Because a lot of times the end customer decides and dictates the type of resins that we will use. So how we are trying to reduce that is actually to work with our customers to transition to more carbon-friendly materials. Now, I know the question asked about measuring. We've already measured our scope 1 and scope 2 emissions and are on track to publish our scope 3 emissions soon. So essentially, from a sustainability perspective, I'll just take that question one step further, is how we help our customers transition, because that will make the most impact. And that's where we are spending a lot of our efforts on, working with our customers to help them transition to more carbon-friendly resins.
All right. Thanks a lot for that. It's interesting to hear how listed companies are moving towards meeting those standards. Okay, with regard to slide 14, this is Yap Kian Wee who has asked, why are the EBITDA before Forex and operating profit not meaningful? I can't remember this. Is that something that...
Oh, I can answer that question. So, I think the EBITDA before Forex and operating, okay, so usually typically for any percentage that's 100% or, infinity, we'll just put it as meaningful, because for the operating profit and loss, it was a loss, it changes from a loss to a profit. So typically for presentation wise, we'll just put it as non-meaningful.
Okay.
Yeah.
Right. Yeah, I figured that. I thought that was the case.
Yeah.
Okay, thanks very much, Daisy.
Yeah.
Okay, James Chias has asked about dividends. Fuyu in the past has been generous in giving out dividends. Looking ahead, will the company's dividend policy revert to such an approach if the financial performance permits?
So we have no plans to change our dividend policy, which is to give out at least 50% of our net profit. So obviously last year when the company made a loss, there was nothing to give. But going forward, there are no plans to change that policy. So if and when company makes a net profit, that will still be the case where we will give up at least 50% of our net profit.
Good, great. Thank you. Okay, Daniel Ting has asked, how's your strategy panning out for the second half of 2024, given that we're in November now?
Strategy is still in the works. I think what I can share is when we rolled out the strategy, the transformation plan, we also mentioned that it was likely to be a 5-year plan because in manufacturing, things move a lot slower compared to a lot of other industries. So when it came to retooling our capabilities, it wasn't something that we could do overnight or in weeks or in months. So that took time. And when it comes to getting new customers in as well, it takes a lot of time. I think, I mean, since we do have a little bit of time here, I'd like to share with you guys the typical timeline when it comes to getting a new customer. So when I mentioned that we have a new NPI team that can talk to our potential customers at an early stage, at the product design, the concept stage, usually as they engage with them at that stage, and let's say we are awarded the business. So let's call it 1st of January 2025 that we are awarded, we managed to convince them. It takes about 3 months for the design for manufacturing phase. So our designers will talk to their designers. We will work on the 2D drawings, the 3D drawings. And after that 3 months, that would be when we start fabricating the tool, or rather the mold, right? The time frame to manufacture a mold is usually about 4 to 6 months. So you have to wait until, so if we started in January 2025, by the time we are awarded by the time we are manufacturing the mold, it's March or April, in another 6 months. So you're looking at Q4 already. And once we fabricate the mold, there'll be a qualification phase. We will decide where to do the molding, so the part production. It could be either at the customer side or our side. And then basically from there on, it takes another 3 months to 6 months before the molding ramps up to the actual production volume. So every time we have a new customer, by the time our investors, the financial impact of the new customer, it might take at least 1 year, 1.5 years, given the time frame that I've shared. And for medical customers, if there's additional regulatory approvals needed, like FDA approvals or HSA approvals in Singapore, you can expect that the lead time is even longer.
Right.
So back to your question, it's already November. We do see traction. We do see the bearing early fruits, as we mentioned, with that 25 new customers that we've had. So I do think that we are on track, but then at the same time, there must be patience before you actually see our revenue and our bottom line have that uptick from this new business. Thank you.
Great, thank you. Thank you very much. Still got time. Well, there's still another 7 or 8 minutes. We will take another question here. Lo Lip Chow has asked, what's the update with the smart factory? What about its utilization rate versus the target rate? And how many % of your revenue is currently from the smart factory?
Okay, I was going to take this, but maybe I'll share some airtime. Adriel, you want to take this?
Sure. So I'm not sure if we can share the exact utilization rates, but as David mentioned, it does take some time for the new business to come in. The smart factory that we built in Singapore, we really only moved in and started proper production, I'd say, start of this year. So it will take some time to ramp up. Obviously, some of the existing projects that we have are already there. That being said, the smart factory houses our tooling center of excellence. As David mentioned, the tooling center of excellence is The tool room and creating a good tool is ultimately very important for us. With the wins of the new project, David mentioned when you win a project, you win the tooling first or creating of the molds. So definitely we have seen increased contributions from our tooling business year on year. And I think you can take a look in the financials when they are released. We do, I believe, share the tooling numbers. David also mentioned that we have opened a new business line in selling tools to our customers. So with all of that, the tool room utilization in our smart factory definitely has also gone up.
Great. Thank you so much. All right, there's time just for one more question before we hand over to the SGX. What is your plan for the supply chain business that was acquired in the recent years? It does not seem to have any synergy with your manufacturing business. This is from Eng Yong.
Daisy, you want to take this or I can take this?
You can go ahead.
Okay, so when acquisition was made, the idea was to have central procurement of our raw material. So our raw material is resin. It's a petrochemical basically. So we buy resin pellets. That is a derivative of crude oil basically in petrochemicals. So the idea of that acquisition was for the supply chain to handle central procurement, to have the economies of scale. So that has actually that was the main rationale for the acquisition. But at the same time, given that the company itself, they were made of, they had a lot of talent in terms of traders. So the same guys that would handle procurement for us would also be in the market and be brokers and middlemen where they would buy and sell commodities at the same time. So I do agree with you. Part of that business doesn't have synergy with the manufacturing business. Although, as I mentioned, the idea was for them to handle procurement of the resins for us. So in a good way, the latest update is instead of having that procurement in the supply chain office, we have now housed it or amalgamated that particular division in Fuyu Corporation. So the supply chain business continues to have their own third-party back-to-back trading for commodities in the market, whereas the central procurement is now housed from the supply chain office to within the manufacturing business. So in terms of the plan, the company will continue to act as a broker or middleman in the commodity sector. It's important to note that the commodity sector, especially in the space that we operate, is a very opportunistic market. So if the market conditions are good, if there are willing buyers, willing sellers, then our business will continue to function. But likewise, if the market conditions are not good, it's overly risky, then we will definitely scale down the business from a risk adjusted basis.
Okay, great. Thank you so much, Fuyu, for that presentation and for the Q&A. We've just got enough time. Thank you to David. Thank you to Adriel and Daisy for an insightful session. And I hope all your questions have been answered. We managed to answer, I think, 9 or 10 questions, which is not bad going for 20 minutes. Okay. Now, the last segment of our evening session is a presentation by Ms Emelia Tan from SGX. Emelia, over to you.
Thank you, everyone.
Thanks, Sivanithy, and also thank you for Fuyu's management team. I think that was a very insightful sharing. All right, so we'll dive deep into providing everyone on the call a bit of market highlights as to what's happening in the Singapore market. All right, so basic disclaimer, this is meant to be educational in nature. Some of the numbers that you see, historical numbers, may not be indicative of future performance. Okay, so moving on to the first slide, right? the STI or the Singapore market so far has generated competitive returns as compared to some of our regional peers, especially amidst global challenges today. Since the end of 2019 until now, STI has generated about 44% total returns, and it's kept pace with some of the regional markets, and in fact has outperformed some of the ASEAN and APAC indices that you see over here. Right. The STI maintains an element of independence compared to some of the other global benchmarks, and we don't really observe a day-to-day correlation because of our high bank weightage. The three banks make up about 55% of the STI weight. And in the past 4 years, in fact, almost 5 years already, we've seen retail investors been very active in the Singapore market, net buying Singapore stocks. The net retail inflow into our Singapore market in total up to now is about 15 billions. So the numbers that we have seen show that retail investors tend to be a bit more active when STI underperforms its peers as opposed to the opposite. Perhaps retail investors riding the opportunity to pick up more. GDP in Singapore for 2024 is set to double this year. And for the outlook for 2025, the recent MAS October 2024 Macroeconomic Outlook Report, it has noted that the consensus outlook for Singapore's economy in 2025 is cautious optimism with steady growth alongside moderate inflation and some ongoing global uncertainties given the mixed global outlook that we will continue to see in 2025, one of which is the geopolitics continuing to be a focus going into next year. Now, aside from that, digitalization, sustainability, these will continue to be some of the key structural drivers which will impact some of our corporate strategic transformations. And for Singapore market in 2025, MTI actually maintains that Singapore's GDP is looking at around 1 to 3% due to manufacturing and trade-related services projected to grow. And MTI also sees healthy growth in some of our outward-oriented sectors like infocoms, finance and insurance, and also tourism-related sectors will benefit from the continued recovery in tourist arrivals. On the other hand, consumer-facing sectors may face some of the challenges from the increased local outbound travel as the locals travel overseas. In November, what we saw, especially in early November, we saw STI exceed 3,700 levels and reach a 17-year high. So on a year-to-date basis, STI has outperformed. It has gained 22% from a total return standpoint. In fact, outperforming some of the regional benchmarks, regional markets. FTSE APAC and the FTSE ASEAN indices, they generally return at about 10 to 12% from a total return standpoint. So where are we today? The STI is about 5% away from its last high seen in 2007, which was about 3,900 levels. From a valuation standpoint, we actually see that it doesn't look as stretched as they were 17 years ago. In fact, when you look at the Straits Times Index price to book today, it is about 1.3 times. And this compares to about 2.5 times when the STI previously tested the 3,900 levels back in 2007. And analysts and the Bloomberg 12-month consensus estimate target price on STI has recently also further increased from 3,918 to about 3,943 levels. So what's driving the STI's performance lately? The banks have been a big driver for the STI. Right? Banks make up about a quarter of the daily volume that we see in the Singapore market and have been a huge driver of our growth for the Singapore context this year. Returns for banks have been very strong. From the end of 2019 until now, banks have almost doubled their total returns, and they're now trading at dividend yields of about 5 to 5.5%. And the bank's weight, when we looked at 2019, the bank's weight was, they make up about 40% of the index. Today, it makes up over 55% of the benchmark. So what's been driving some of the bank's performance, right? It's the stronger income that they're seeing due to the higher interest rates. Banks have been a beneficiary of that. The bank's combined net interest income was at about 8 billion for the last quarter, and this is the 7th consecutive quarter that the three banks' NII have been above $8 billion. Not just direct investors into the STI, we also saw influx of investors buying the STI ETF over the past 3 years as well. This particular slide is a sector heat map. What we have done is to show some of the stock performances of our different sectors across the past quarters. As you can see, the red ones, right, in first quarter 2020 and also second quarter 2022, telcos were the most defensive in a down market. Travel and hospitality at that time during COVID period is underperformed, and then there was a recovery from 4Q 2022, and this particular sector, travel and hospitality, were beneficiaries of the reopening and the return to travel. In the recent quarters, banks have outperformed. Not just banks. Last quarter in 3Q 2024, we saw REITs make a huge comeback. The sector as a whole recorded one of the best quarters on the record. And this is also largely because the Fed has also announced in September that it will cut interest rates. In fact, it was the first time the interest rates have been cut in the last 4 years. So the key point here to share with everybody is that the Singapore market has opportunity for investors that are looking to invest in the long term, as well as if your investors are looking to trade across the different quarters, there are also opportunities in the Singapore market. As we talk about REITs, because they have been one of the more active sectors this year, not just record performance in the last quarter, but from an activity level for within the REIT space in terms of acquisitions, divestment, activities, it's been quite active. REIT managers also continue to seek to find growth opportunities for their unit holders. And they do so through optimizing assets, for example, through the divestments, capital recycling, so that they can channel funds into newer properties, growth markets, and to capture some of this growth. So as of mid-November until this quarter, we have seen 10 acquisitions, 5 of which are, we have seen 10 transactions, of which 5 are divestments and 5 are also acquisitions. And in the year to date alone, the acquisitions alone exceeded 20 different acquisitions on a year-to-date 2024 basis, worth over $4.3 billion in assets. So that's very encouraging as we see some of these secondary market activity coming online again. This is much higher than the entire last year, which was about 17 of these acquisitions, valued at over about $3.7 billion. Some of these acquisitions, our REITs have ventured into new markets, new segments. For example, Parkway Life REIT, they've recently bought about 11 new nursing homes in France. FLCT, they made their first Singapore logistics property purchase. Keppel DC REIT, earlier on, you might have also recalled them making announcements to say that they have made their maiden entry into Japan data center assets. And last week, they've also announced that they will be buying 2 hyperscale data center in Singapore's Genting Lane near MacPherson from a Keppel joint venture. And this was funded through a private placement that was well covered, about 3.4 times covered by investors. And therefore, from a sector perspective, we see that we're cautiously optimistic on this sector, given that some of the activity levels are starting to return, and this is very encouraging. Another update on another of our sector, which is the technology sector. Now, in the past decade, tech stocks have been in the spotlight really because of generative AI expanding tech applications. And this saw tech stocks market share in the global indices grow from about 10% to now 25%. In the Singapore context, while we have just the venture corporation in the STI, but outside of the STI, we have a cluster of over 70 tech-related stocks across hardware equipment, digital, semiconductor, telco services, companies, so on and so forth. And on this slide, what you can see here are the 10 most traded stocks within our Singapore technology sector. Venture is the largest, and in the recent 3Q 2024 group revenue saw some decline because of weaker demand in life sciences, lifestyle consumer, test and measurement, instrumentation tech sectors. And this is really in line with the mixed performances that we have also observed in the downstream electronics industries in 2024, with a lot of the cyclical factors causing a slower recovery. And if you look at across the 10 most active traded tech stocks, the top performance in terms of a price performance, it's Valuetronics. On a year-to-date basis, about 13% total returns, and this particular stock, Valuetronics, is trading above its 5-year price-to-sales average. Asia continues to remain responsible for almost about 3/4 of global electronics exports. And MAS has also shared that ASEAN's pie within this space has grown. And in fact, we have grown to about close to 20% over the past 10 years. And our Singapore tech sector remains very relevant here. For example, we've got companies such as Tech Global, Valutronics that have manufacturing facilities in both China and ASEAN, as well as ISDN's capabilities are focused within China, Suzhou, Huzhou, and Zhejiang. Last slide that I have, some latest launches and developments in the Singapore market. This fourth quarter until now, we have seen 4 IPOs in the Singapore market. First one is PC Partner. It's a secondary listing in the Singapore market. They are a leading provider of innovative products. They focus on video graphic cards and also some of the electronics manufacturing services offerings. Google Entertainment, they operate multi-entertainment concepts, family-friendly karaoke facilities. Some of the familiar names that maybe some of us have come across would be the Have Fun Family Karaoke and also Have Fun Live Show. The third one, Etica, they are a Singapore-based full-service commercial interior decoration and mechanical, electrical, and plumbing engineering company. It offers a one-stop shop solution for customers from your design, end-to-end, all the way to project management, to servicing and maintenance for the interior fit-out needs. And the last one, Food Innovator Holdings. Maybe some of us are more familiar with their restaurant names like Man Man, the Tendon Kohaku, which is the tempura rice bowl. So they are a restaurant operator which focuses on Japanese dishes, and they also have Japanese-inspired European dishes, and they've got restaurants across Singapore, Japan, and also Malaysia. And last but not least, we've got some new product launches in the Singapore market. We have 5 new Hong Kong underlying SDRs, Singapore Depository Receipts, on Tencent, Alibaba, Bank of China, HSBC, and also BYD. This widens our existing SDR shelf, which previously had 8 Thai SDRs that cover about 40% of the SET index. And lastly, in terms of average for investors that are looking for leverage, also looking to long or short stocks with about 5-7 times leverage, we now have also the US Magnificent 7 for investors to trade that. So that includes names like Tesla, Nvidia, Alphabet, Apple, Amazon.com, Microsoft, and also Meta. And this is in addition to the current shelf which we have in terms of index DLCs, Singapore stock DLCs, and also Hong Kong stock DLCs. And with that, the last slide, for those that are looking out for some of the latest updates in the Singapore market, you can scan this and also follow our SGX Invest Telegram channel for some of the latest content coming from the SGX research team. So with that, I'll pass the time back to Sivanithy. Thank you, everybody.
Thank you very much, Emelia. Very informative presentation. And it leaves me to thank the team from Fuyu for their presentation. The aim of this Corporate Connect sessions is an initiative that SIAS came up with to provide greater awareness and raise amongst retail investors of listed companies to raise their profile and to reach a wider audience. I hope that today's session has met that objective. For those of you who have attended, I hope it's been a useful a useful learning experience. If for those who have missed it, you can rewatch the webinar on SIAS's YouTube channel. This is a weekly webinar, so visit our website to get updates on our upcoming investor education program and initiatives. The next Corporate Connect session will be on 3rd December, featuring Sasio Reed. You can also type into the chat box suggestions for any companies that you would like to see featured in this initiative of SIAS together with SGX. So with that, all that remains for me is to thank everyone for attending this and for taking the time. I hope to see you at the next session, and thank you, and have a good evening. Good night.
Thank you, and thanks everyone.
Okay, thank you.
Thank
Good
you.
night all.
Bye.
Bye.